Well, for more now on the outlook for hedge funds, we turn to Don Steinbrugge, managing partner of Agecroft Partners. This is a Richmond, Virginia-based firm that advises hedge funds and investors. And he says we've heard a lot of comparisons about 2008 from a number of people, but you have resurrected Yogi Berra's famous quote, one of his many famous quotes. It's not deja vu all over again. You're saying it's not deja vu all over again. So what makes 2008 a different period of time than right now?
Well, first of all, I'm talking about the size of the hedge fund industry. So after the market decline in 2008, you saw a 40% contraction in the hedge fund industry, half of which came from performance, the other half came from net withdrawals from the industry. And what's different today is, first of all, the investor base. If you went back to 2008 and you saw who was withdrawing the money, it was primarily high net worth individuals and fund of funds. The pension funds were very stable. Endowment funds were somewhat stable. Today, pension funds represent a much larger percent of the market. In addition to that, fund of fund investors that withdrew back then didn't know what they were buying. They thought it was a bond substitute. They expected 4 to 5% above treasuries. They didn't expect negative returns. When expectations don't match reality, they withdraw. Today, they know what they bought. They should be much stabler.
Don, do you also think it's a case of the strong sort of have survived in terms of the actual managers themselves? Was it the worst performing that kind of went out of business during that period of time, and the ones that have sort of managed to last through 2008 are actually posting better performance?
You know, I think it's that, and I think it's a number of other things. I think, in 2008, you had the Madoff fraud. That scared a lot of people to invest in hedge funds. Since then, due diligence has improved relative to hedge funds. The probability of a multi-billion-dollar fraud is a lot less. So you don't have that overhang in the industry. You don't have as much leverage. It used to be that fund of funds used a lot of leverage to boost their returns, and after 2008, they had their leverage facility yanked, or they had bad performance because they're leveraged, so that's out of the picture. In addition to that, you had a situation where there was a lot of illiquid strategies that offered monthly liquidity, and when investors wanted their money, they threw up gates, they suspended redemptions. That reduced confidence in the hedge fund industry, which also stopped flows into it. And today there's a much better alignment with liquidity provisions and the underlying investments.
And I have to imagine the institutional investors need a place to find yield. If they're not going to get in the stock market, they're not going to get in the bond market at this point. Hedge funds have to represent, an asset class that can actually get them to sort of their performance targets.
That's absolutely correct. If you're on the investment committee of a pension fund, you don't need to generate positive returns. You need to meet your actuarial assumption, which is 7.5%. And most investment committees, remember, end of 2008, sitting there hearing their long-only managers come in saying they were down 45%, their emerging market managers down 50%, their high yield down 28%. And hedge funds, held value much better than long-only. And as a result of that, you've seen the significant increase in allocation from pension funds to hedge funds.
So, Don, I know you don't expect net outflows, but you do expect some rotation.
You may have some net outflows, nowhere near compared to 2008.
But you think the bigger movement will really be kind of rotating out of certain strategies and into others. So I just wanted to go through some of where you expect the inflows.
Perfect.
So,
what do I think? I think people are going to be focusing on those areas that are not correlated to long-only benchmarks. I think global macro is going to continue to see a lot of flows. I think there's tremendous demand for CTAs. They represent 15% of the marketplace, but are under-allocated by pension funds. I think you're going to see market-neutral equity that doesn't have beta in it. I think you're going to see, for fixed income, spreads have come down significantly. So as you see year to date, mortgage arbitrage is doing really well. The reason mortgage arbitrage is doing really well, it's a very inefficient part of the marketplace. You can make a lot of money trading it because of how it's priced.
They're also making a big bet. We've had a couple different people on talking about mortgage arbitrage. They are making a big bet that refinancing activity won't pick up despite rates sort of falling lower, right? So there's been this ability to sort of arbitrage that. Is there anything that changes how well these strategies do over time? I know you like emerging market as well. Trading-oriented funds are also sort of funds that you think will start to see bigger inflows. But why are those going to do particularly well, and what's a catalyst for them not performing well?
Well, when it comes, are you talking just about mortgage arbitrage or just in general?
Mortgage, I was using that as an example, that each one of these, sort of their performance, their inflows is going to be based on them performing well, quite obviously, and things could change, or their assumptions can change quite dramatically.
Well, this is what I would say. I think non-correlated strategies, there's going to continue to be a lot more stronger interest in those. If you're investing in mortgages, I would not invest in someone who did a big beta trade. Went long mortgages, spreads came down, they did really well. I would focus on alpha generators. These are people that are doing a lot of trading in their portfolio, are able to move the market, are not reliant on just what is the speed of prepayments, are using a very diversified portfolio of techniques to take
All right,
advantage.
And let's do a little Finance 101 while we're at it. So when we talk beta trade versus alpha trade, alpha I think of as being your manager's ability to really outperform the market. Right?
Yeah, well, beta is kind of a free lunch. If you're long the equity marketplace and the equity markets go up, you're going to get a return just because you're long equities. In fixed income, the same thing. If you're long mortgages and spreads come down or interest rates come down, you're going to get a capital gain. What you don't want to do is invest in someone where that's been all the return. You want to invest in someone who's generated a lot of returns by trading their portfolio, because that's not reliant on the direction of the market.
Let's talk about where you expect to see outflows, right? It makes sense to me that long bias equity managers, why pay a long bias equity hedge fund manager when you could just buy an ETF?
Well, I think you're going to see money shifting away or less demand in long-short equity managers that have a lot of exposure to the equity markets for those people that are afraid of an equity sell-off. I also think, a lot of fixed income strategies have done phenomenally well in 2009, 2010, and so far in 2011. Spreads have come down, and I think people that have a lot of beta in their portfolio are going to start losing assets to people that make money in different ways.
And then very quickly, one last point here, high-profile managers with poor performance. There are a lot of big hedge fund names out there that have not had a good year.
Well, that's true. And one of the problems we had after 2008 and all this pension fund money going to the hedge fund industry is it tended to be concentrated in the largest hedge fund managers. There was one point where almost 100% of net flows were going to hedge fund managers $5 billion and above. And what that's caused is some managers to have way too much money. And when you have too much money, it is much more difficult to generate alpha. What we've seen over the past 9 months is a slow shift away from the largest managers towards more smaller and mid-sized managers, more nimble, can generate higher alpha.
All right, Don, always appreciate your insight here on Fast Forward. We got to leave it there. Thanks so much. That was Don Steinbrugge, managing partner of Agecroft Partners.